April 10th, 2021, newsletter number 3, The Downside to Momentum Investing by Max Gottlich. Buy the leaders, sell the laggards. Risk ranges are typically associated with either short-term or long-term momentum investing. What's the purpose? This form of investing is used to mitigate risk based on a cumulative percentage rate of change, otherwise known as momentum. Momentum investing exploits sentiment bias, so it's important to consider a variety of sentiment indicators, as we will review shortly, in order to efficiently confirm the sentiment position underlying the security. Asset managers tend to use multi-factor models focusing on price, volume, and volatility, or vol, to assume all elements of momentum are considered. There is no question that momentum investing has been a profitable strategy, especially in recent years. Obviously, the longest ever stock market boom, S&P makes new all-time highs as of this writing, supports the triumph in momentum investing. The simple act of buying the best performing stocks, sometimes without the essence for rebalancing periodically, has not only dominated the stock market, but it has enabled a new regime across capital markets. This domination, however, is largely comprised of leveraged retail traders who buy naked, out of the money call or put options, typically in one contract increments. The speculator in this case wins the jackpot, gets drowned by theta decay, or expires worthless. Certainly, this is not a suitable long-term strategy for consistent returns. As a result of this speculative behavior, the S&P 500 surged about 50% from April 2020 to currently, while the earnings yield on the S&P 500 is at its lowest point in 20 years and beyond that in history. This diverging relationship between what the market prices versus poor fundamentals is usually associated with the colloquial term bubble. In other words, the difference between what the market perceives versus what reality beholds is very large and should be considered as a risk to your portfolio. Speaking of the S&P 500 and its overextended uptrend, it's not surprising that over 80% of stocks are trading above their 200 daily moving average, which hasn't happened since the great financial crisis and before that during the dot-com bubble. Today's stock market environment is exceptional in terms of price performance. In fact, the latest prints on the S&P 500 PE ratio, price to earnings, and the PS ratio, or price to sales, is 42.04 and 3.03 respectively. To put these numbers in context, check out the charts below, with the first chart representing the PE ratio followed by the PS ratio of the S&P 500. It's also important to consider the structure of major US indices such as the Dow, or which is price weighted, and the S&P, which is market cap weighted. Price weighted indices are entirely related to the prices of the individual stocks trading in a basket or an index. The higher the price of the stock, the higher the weighting is in the index. The other kind of weighted index is the market cap weighted index, which determines its weights based on the market value of the stock. The calculation is very simple. Multiply the share price by the market cap of the stock. Obviously, the stocks with the highest market caps will have the most influence on the performance of the index. In December 2020, Tesla joined the S&P 500 with massive price appreciation, which helped Tesla become one of the largest companies in the S&P and therefore one of the largest market cap weights in the index at almost 2%. Of course, if Tesla or Apple, which has the largest weight in the S&P, retraces to the downside, that will affect the stock market index negatively. So, the downside risk for momentum investing is the risk of major drawbacks in your returns, since your entry point will most likely be at the top end of the risk range. The laws of gravity inevitably come into play. Thank you.